Hey traders and investors, it's Serge Berger here. One of the things we need to do to be able to manage our money more successfully is not buy stocks that have gone vertical over the past few days or the past few weeks. And one of the best examples I can give you right now is Apple. And before you start tuning out and calling me a top caller in Apple, that's not the case. I'm just trying to show you it's a good example of a stock that just literally won't go down and has had a very steep slope over the past couple of weeks, really, if not the past few months, depending on how you count that. So let's have a look at this very simple chart of Apple. And I'll make this a little bit easier, actually. I'm going to go with a plain white chart with a candlestick with the candlesticks on them. And I'm going to use a weekly chart. And you can kind of see how steep this has been. Now, if we go a little bit deeper and make this a monthly chart, so each bar becomes a monthly bar, and we're just going to pull this back a little bit. Okay, look at this move this stock has had. What we're seeing now again here is very much similar to what we saw here back in April of 2012 and really throughout the first half of 2012. So it's extremely important to keep that in mind. Apple also, by the way, right now has a market capitalization of uh, over 700 billion. Right. So that's basically twice as much as the next largest market cap company, which I think last time I checked is ExxonMobil with somewhere near 350-ish plus billion market cap. So that is a meaningful market capitalization. Now, not surprisingly, Apple has a very close correlation to the S&P 500, so the broader stock market. If you look at this chart here, this is basically comparing Apple. I think Apple is in blue and the S&P is in red. So you can see very close correlation. So from that point of view, if Apple ever has another down day, if it ever goes down another day, which of course I'm saying this jokingly, of course it will, it's probably not going to be so good for the broader stock market. So if we take all this together, a lot of pain in this business can be avoided and then our returns can dramatically be improved if we just don't chase stocks like this higher, okay? I don't think Apple's a bad company to own, but it doesn't mean you have to buy it after it's rallied very strongly for a multi-month period. If you just look at the move here, just since end of January, basically, the stock has rallied about, let's call it 17, 18%, right? It's just silly to start chasing a stock higher like that, particularly if you're planning on holding it for like a medium term period. It just doesn't make sense. You get much better entry periods. The stock ultimately will retrace, 5, 10, 15, maybe 20% where you get a much better entry point. It's a very straightforward way of making managing your money much easier with a lot less headaches and arguably and definitely, I should say, much better returns. So I hope this makes sense. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.